Now, standard 5A, diligence and reasonable basis. So this says that whenever I am giving any kind of a recommendation on a particular stock, you have to have some, proper basis, proper reasons why I am recommending this particular stock, and I should have done some research. Now, I should not recommend a stock just because I have a gut feeling that this particular stock will go up, or I have some insider information, or I've received a tip from somebody that's saying that this stock will go up. I should have done my research. I should have proper fundamentals. I should have a proper reasons why I feel that I am recommending this stock and how much it will go up, what is the expected target, what are the conditions that are required in order for this particular upside to be possible, what are the risks involved, when this will happen, when it may not happen. I need to have a proper kind of understanding, and I research should be supporting this particular recommendation. Members and candidates must exercise diligence, independence, and thoroughness. So, diligent means you have to be very careful. You have to be independent. Nobody should force you to give any kind of recommendation. And you must have done your research thoroughly. You must take into account all the factors that are necessary for, do this research. Like you have to check the economy, you have to check the industry, you have to check the company's performance, historical performance, you have to check the competition, you have to check the market, the demand, how the economy is doing, and you have to identify a lot of factors which will necessarily bring in the revenue and the profits. In analyzing investment, making investment recommendations, and taking investment actions, you have to have a reasonable and adequate basis supported by appropriate research and investigation for any analysis, recommendation, or action. The application of this standard depends on the investment philosophy followed. So you have to follow all the steps that your firm takes in order to analyze a particular stock, the members' role in the investment decision making process, and the support provided by the members' employer. So, there might be a research team, and in this team, let's say there are three people working. This person is responsible to collect all the information, pass on to this particular person. This person will prepare the financial model and share the research report to the senior analyst. The senior analyst will check everything and they will disseminate this information to the client. So each one of them is responsible for the particular action that they are supposed to follow. They must be diligent, independent, and they must have a reasonable basis for whatever information they are passing to the next person. If the firm is using secondary or third party research, let's say I am a wealth management company and I have a lot of clients. Now I'm not doing research on my own. I am buying the research from a third party. So buying third party research is allowed. So this is not a violation. You're allowed to buy third party research, but you should only see to it that the research that they are doing is diligent, reasonable, independent, and they are not coming under any kind of bias or any kind of pressure, and they are not giving any kind of false information. So you are allowed to use secondary or third party research. You must take reasonable efforts to determine that such research is sound. Examples used to evaluate the research. You must review the assumptions that these guys are using. Are they very rigorous, and whether they have taken proper information which is relevant at this particular time? You must evaluate the objectivity and the independence of the recommendation. It should not happen that somebody is forcing this third party and compromising their independence, and the third party is sending you a research report which is totally compromised. So that should not happen. Now, let's say you are working in a team and a member of the particular team does not agree with the independent and objective view of the group. So let us say there are three people working, and let's say Mr. C is not agreeing to what A and B are saying. So Mr. C has to first decide what A and B are saying. Is it a difference of opinion, or are A and B having a biased opinion? If A and B are having a biased opinion, then C is correct, that A and B are succumbing to pressure and they are giving a wrong recommendation, which is not independent and thorough. But if it is only a difference of opinion and A is independent, B is independent, C is independent, nobody is pressurizing anything, then C has to decide whether he or she has to be a part of the group or they want to leave the group. Okay, he or she does not need to decline to be identified with the report as long as consensus opinion has made a reasonable, adequate basis. So A and B are having the majority, they are not agreeing with C. So C can decide whether they want to be in a part of the team. And if they are preparing a research report, they can allow their name to be printed on the report. So this report was prepared by Mr. A, Mr. B, and Mr. C. Even though C may not agree to certain contents of the report, but if they feel that the contents are fine, A and B have their opinion and they have a majority opinion and the opinion is independent and objective, then C can continue associating with them. So you need not leave the group or you need not say that, okay, if you are going to put this information in the report, don't include my name. So all that is not required if the analysis is independent and objective. Members who develop quantitative systems and models must exercise more rigorous due diligence as compared to members who ultimately use the model. So the person who is preparing the model should be very careful. They should have tested the model properly. They should know how sensitive the model is to the inputs. Members who use the model must know the assumptions as well as the limitations of the model. So both of the people, the creator of the model as well as the user of the model, must understand how the model works. They must know the benefits. They must also know the limitations of the model. Example, Hawk manages the corporate finance department of Sarkozy Securities Limited. So we have Hawk, we have Sarkozy Securities Limited. The firm is anticipating that the government will soon close a tax loophole that currently allows oil and gas exploration companies to pass drilling expenses to holders of a certain class of shares. The firm is anticipating, so this is their opinion. Because market demand for this tax advantage class of stock is currently high, Sarkozy convinces several companies to undertake new equity financings at once before the loophole closes. Time is of the essence. So, you have to act before it is too late. But Sarkozy lacks sufficient resources to conduct adequate research on the prospective issuing companies. Hawk decides to estimate the IPO prices based on the relevant size of each company and justify the pricing later when her staff has time. So you are asking people to invest in certain companies, but you don't have time to do a research on those companies. So you do not have a proper diligent and reasonable basis for your recommendations. So you will be in violation. It should not happen that, okay, I have a gut feeling that this stock will go up. I'll ask my clients to buy the stock, but then later on at the end of the day, when I'm having time, I will do the research. So first do the research, then give the recommendation. It should not happen that first you are giving the recommendation and then you are doing the research. So such an omission can result in the investor purchasing the shares at prices that have no actual basis. So they would be in violation. So Daliwal works for Hendrick Brokerage. He had just persuaded Figgins Resources Limited to allow his firms to do a secondary equity financing at Figgins Resources' current stock price. Because the stock has been trading at higher multiples than similar companies with equivalent production, Dhaliwal presses the Figgins resource managers to project what would be the maximum production they could achieve in an optimal scenario. So they are doing some forecasting, and this person wants the company to project what would be the maximum production they could achieve in an optimal scenario. Based on these numbers, he is able to justify the price the firm will be asking for the secondary issue. So you're trying to price an FPO, and let's say they are asking for a price of $300. So I am asking the company to have and to create or to evaluate the optimal scenario, the best possible scenario that will help me to justify why I am asking for a $300 for the secondary issue. During a sales pitch to the brokers, Dhaliwal then uses this numbers as a base case production. So the best case scenario is used as the base case scenario that Figgins Resources will achieve. So he is actually not diligent and reasonable when for asking for the price that he is claiming should be the value of the FP. So I'll just give you a brief. Whenever we are preparing a financial model, we take a base case scenario, assuming things will happen in a very, in a very, normal way. So what if the economy grows at a normal rate of 6%? What if economy is experiencing an inflation, which is normal rate of 4%? And then I will assume a best case scenario. What if the economy grows at 10%? What is inflation is only 2%? And then I'll estimate the worst case scenario. What if the economy grows at 2% and the inflation is 10%? So I must evaluate all the three possible situations and not only the best one to come up with the price. What this person is doing is he is only taking the best situations in order to justify that, okay, my FPO should be priced at $300 per share. So that is actually a violation because it is not reasonable and it is not diligent, and he doesn't have a reasonable basis to quote this particular price. Standard 5B, communication with clients and prospective clients. So when you're communicating with client about, let's say, any purchase recommendation or, the portfolio performance, and you're making any kind of communication with future expected clients or prospective clients, what kind of ethical principles and standards you must follow. So members and candidates must disclose to clients and prospective clients the basic format and general principles for investment process used to analyze investment. So let's say I am a research firm, so I should disclose what are the basic parameters and principles that I use in order to evaluate a particular investment and do a research and then give recommendation. So what is the basic format that we use to analyze investment, to select the securities, to construct the portfolios? And if there is any change, we must disclose that change to all my clients that might materially affect those processes. So I'll give an example. So let's say my firm analyzes only dividend paying stocks. Okay, so I analyze only those stocks that are paying dividend, like Hindustan Unilever, Vedanta, TCS, etc. Now, later on, what I have also started doing is I have also started to evaluate those stocks that are not currently paying dividend, but will start pay dividend in the next 2 years or so. So my primary criteria of evaluating the investments was they must be dividend paying stocks. But later on, I've also started including stocks which are not currently paying dividend, but have the potential to pay dividend in 2 years. This is the change in my investment philosophy, in my change in my principle, change in my style. So I must disclose that now we have also started evaluating companies that have the potential to pay dividend in the next 2 years. So this is a change in my investment style, and it must be communicated both to my existing clients as well as to my prospective clients. The third point, you have to distinguish between fact and opinion. So fact is something which has historically happened and it is true. It has got some historical data that will help us to prove that, okay, this thing has happened. For example, your name and your age is a fact. Opinion is your perception about something, and opinion will differ between people. So fact is something which is historical. Opinion is something that we expect from the future. So when we are preparing a presentation, we have to distinguish between what is a fact and what is an opinion. The investment has given 12% returns per annum on average for the last 5 years. This is a fact. The investment will give or can give or is expected to give. This is an opinion. This much return in 2026. Okay, so whatever has happened historically, that is a fact, and whatever is your opinion that may happen next year, that is something which has not yet happened and it is a future expectation. Fact is a statement that can be verified for truth. Opinion is an expression of your belief and it cannot be verified if it is true or not. Disclose to clients and prospective clients significant limitations and risks associated with the investment process. So whenever I'm giving a recommendation, you must also give them a kind of a stop loss. So let's say the price is 100, my target is 150, my stop loss is, let us say, 85. So if by any day things do not go my way and it goes sideways, so if the stock price falls to 85, I must exit over here. Or I can keep holding the stock till it reaches the price of 150. Facts for historical figures and opinion are future projections made with sensitivity analysis. Developing and maintaining proper communication is important for providing high quality financial services. The standard requires members to effectively distinguish between opinion and fact. Also, members must illustrate to the client and prospective clients their investment decision making process. So we have explained all this. All type of communications are included in the standard. So it might be a verbal communication, it might be a return, it might be a research report, any kind of email, WhatsApp text, any kind of background reports, supporting documents, etc. So Mark works in a branch office for a large wealth management firm. The firm fees are based on a percentage of the value of the assets managed in each client's account. So it is percentage of AUM, asset under management. Fees are a percentage of asset under management. The firm has a standard method for valuing assets and calculating fees for all the clients, which is disclosed to each client at the outset of the relationship. So what value of the AUM? The AUM can have an opening value, AUM can have an end of the year value, or it can also have average value. So we have to calculate the percentage of AUM means which value of the AUM, the opening, the average, or at the end. Mallow becomes aware that over time, the firm has transitioned to using the market value of the client assets at the end of the billing cycle instead of the average daily balance of the account. So instead of using average, you have changed it. Now you have started using the end. So this is actually a change in an important funda or a style followed by the firm. So it must be communicated to the client. And you have also started including cash and cash equivalents in the fee calculations, which were previously excluded. So that means, let's say the client is having 100 CR portfolio, out of which 90 CR was invested and 10 CR was held in cash. Earlier, we used to calculate the fees only on the amount invested. Now we have started to include even this cash balance. So this is a second change, which is very significant. So it must be communicated. So if they are not communicating and if they are changing the style of calculating the fees without disclosing it to the clients, they might be in violation of communication with clients and prospective. So you have to notify your clients about this particular change. Because when you notify the client, you are giving them an opportunity to decide whether they want to continue with you or not, or they want to switch and join somebody else. Richard is a mining analyst for East Bank Securities. He has just finished his report on Bosy Bay minerals. Included in his report is his own assessment. So own assessment means it is an opinion of the geological extent of mineral reserves likely to be found in the company's land. He completed the calculation based on the core samples from the company's latest drilling. According to calculations, the company has more than 500 ounces of gold. This is your opinion on the property. Docs construe the research report as follows based on the fact that the company has 5 lakh ounces of gold to be mined. I recommended a strong buy. So it's actually an opinion, but he is taking it as a fact. Then he is in violation of communication with clients and prospective. Okay, his calculation of the total gold reserves is actually an opinion and not a fact. Standard 5C, record retention. So whatever data we are sending to the clients, the prospective clients, how long should the firm retain this particular information? Now, if I am using any kind of materials to prepare my research report that are supporting documents, how long do I need to hold this supporting documents as well? So members and candidates must develop and maintain appropriate records to support their investment analysis, recommendations and actions, and other investment related communications with client and prospective clients. Members must maintain the research reports that supports the analyst's conclusions and investment actions. If no other regulatory standards are present, CFA recommends 7-year holding period. So if your company says you have to hold it for 5 years, CFA says 7 years, you have to follow the stricter standard, 7 years. If your company says you have to hold it for 10 years, CFA says 7 years, it should be 10 years, you have to follow the stricter standard. This holding period is for the firm and not its employees or candidates. So you need not keep the document with yourself that, oh, I have to maintain this document for 10 years, even though you have left the organization. The firm is responsible to hold the records for these many number of years and not the employees. So records are property of the firm. They are not the property of employees or the candidates. One of Nicholas' clients is upset by the negative investment returns of his equity portfolio. The IPS of the client requires that the portfolio manager follows a benchmark-oriented approach. The benchmark for the client includes a 35% investment allocation in the technology sector. So the client is saying that you have to make an investment as per a particular benchmark. And in that benchmark, 35% of the investments is towards the technological sector. So it's saying that I have to invest as per Nifty 50. And in Nifty 50, I find that, though this is not correct, but in Nifty 50, I find that 35% of the stocks are IT related stocks. So if 35% of stocks in Nifty 50 are related to IT, then my portfolio will also have 35% investment, which is made in IT. The client acknowledges that this allocation was appropriate. So that means that fund manager has not done anything wrong. But over the past 3 years, the technology stocks have suffered severe losses. So the manager has followed whatever the client is saying, but the returns are not generated because IT stocks or IT sector was not doing well. The client complains to the investment manager for allocating so much money to the sector. Over here, the manager is not in violation because he has followed everything which is there in the IPS. So that's why IPS is an important document. Tomorrow, the client says that, okay, you have not generated return. I can show him the IPS that you had told me to do this. I have followed your instructions and this is the outcome. So over here, the client, the manager or the CFA charter holder or the candidate is not directly responsible, but he should first determine that whatever benchmark was set, is it appropriate to the client's investment objective? If whatever benchmark or whatever IPS investment allocation I'm selecting, that only is not appropriate, the manager should have informed the client first whenever they are starting the relationship. But now over here, you have followed the IPS and assuming the IPS was prepared and updated regularly and it is suiting the needs and the risk profile of the client, then the manager is not in violation. Second example, Young is a research analyst who writes numerous reports rating companies in the luxury retail industry. The reports are based on variety of sources, including interviews with the company managers, manufacturers, and economics, on-site company visits, customer surveys, and secondary research from the analysts covering related industries. So he's doing a comprehensive research, taking data from a lot of sources in order to give rating reports to the companies. What he should do it, he should keep all the information or records that he have collected carefully, and he must maintain it for 7 years what CFA recommends. If his firm recommends more than that, then it is absolutely fine. If he doesn't maintain such file, then he'll be in violation. But if he is maintaining files, then it's absolutely right. So let's say I'm recommending a particular stock. I'm saying that it is a buy. I have done a lot of research and I've saved all my research work and I can prove that I have given this buy recommendation. The price was 100. I expect it to go to 140 based on these documents. I have saved all these documents. But if the price does not go to 140, then I will not be held accountable. Why? Because my research was independent, thorough, diligent. I had maintained all the records. So even if targets are not achieved, tomorrow nobody will blame you that you have not done the research properly, you have not maintained any records. You can show everything as supporting proof. Now we'll take a 5-10 minute break and then we'll start with standard 6. So do you have any questions that you want me to address? Otherwise, we'll take a 10-minute break. Now, standard 6A, disclosure of conflict. So members and candidates must make full and fair disclosure of all the matters that could reasonably be expected to impair their independence and objectivity or interfere with their respective duties to clients, prospects, and employer. You must ensure that such disclosures are prominent, are delivered in plain language, and communicate the relevant information effectively. So, continuing with yesterday's example, let's say my father is the ED or my father is the CEO of a particular company, and I am asked to write a research report on this particular company by my employer. So, I must say to my boss that my father is the CEO or MD of this company. There is a conflict of interest. Do you want me to write this research report? If the boss says no, go ahead, write the research report, then it is okay, fine. I'll just write the report with a cautionary note that my father is one of the prominent employee of this particular company. But if I'm disclosing this information to my boss, the boss has a choice. He can ask somebody else to write the research report. To give you another example, let's say my boss has asked me to write the research report on Tata Motors, and I am having, let's say, 500 shares of Tata Motors in my account. or my wife is having 500 shares of Tata Motors in my account. So, of which, let's say I am a equivalent nominee or a beneficiary of this particular account as well. So I can say to my boss that, I'm a beneficiary holder in Tata Motors. I'm having this many number of shares. So do you want me to make a disclosure? Okay. So either I'll write the research report and make a disclosure that the person who is writing this research report is having some ownership in this particular stock, or he has got some ownership interest indirectly, or my boss can ask somebody else to write the research report. So these are conflicts which must be disclosed. You must ensure that such disclosures are prominent, delivered in plain language, and communicate the relevant information effectively. Members must fully disclose all the potential and actual conflict. So even if it is a potential conflict, you must disclose it to your client, prospective clients, as well as to the employers. These disclosures must be clearly stated that I am a beneficiary or I am having some kind of ownership in this particular stock. As the standard requires the members to fully disclose all the matters that can reasonably impair the members' objectivity, it allows the clients and prospects to judge the motive and possible biases. So let's say I'm having 500 shares of Tata Motors in my account and I'm asking my clients to invest money in this particular shares. Now, some clients may think it in this way that, okay, he is recommending us this particular stock. He is also having this stock. That means we can take the risk. But some clients may think the other way. Why is he asking us to buy Tata Motors? Maybe the price will go up and he will exit the investment before us, or he would have bought the share much before us, let's say at a price of 200, and now the price has gone up to 500 or 600. So that's why he wants. Why is he asking us to buy it at such a high price? Does he wants to exit the stock and stick it on us, and he will get a free exit? He will be able to book profits. So these kind of disclosures are important because it helps the clients to judge the motive and possible biases. Disclosure of broker dealer or market making activities, actual ownership of stock, and board services all are included in this particular standard. So in equity or in other financial instrument subjects, you will be understanding the difference between broker and a dealer. Just to give you a short note, broker is somebody who will help you find a counterparty. Dealer can act as a counterparty. So an example is, let us say, True Value or any old car dealership. So let's say you want to buy a second-hand car, you go to the dealership, you buy the car from the dealer. So dealer is somebody who has the inventory and he will buy and sell your that particular commodity with you. Another example is a forex dealer. If let's say you are going to trip to the US, you will buy USD from the forex dealer. After coming back, you will sell the USD to the same forex dealer as well. So a dealer is somebody who has an inventory and who is ready to buy and sell whenever required. So he acts as a counterparty. So if there's any kind of dealer or broker relationship, you must disclose this as well. Now, equity stocks are traded in the exchange, but bonds, forex, most of these things are traded in dealer-driven markets. So you buy these instruments from one of the dealers. Members, while reporting conflict of interest to the employer, should give enough information so that the employer can judge or assess the impact of the conflict. Recommendation, if you're receiving any kind of compensation, any bonus or any commissions, this must be disclosed as well. For example, Henry is a research analyst with Williamsburg Company, a broker and investment banking firm. Williamsburg Mergers and Acquisition Department has represented Jimco, a conglomerate, in all Jimco's acquisition for 20 years. From time to time, Williamsburg officer sits on the board of directors or various Jimco subsidiaries. Henry is writing a research report on Jimco. So in this research report, he's allowed to write the report, but he should disclose that this particular firm is one of the service providers to the company for related to mergers and acquisitions, and some of the employees of Williamsburg are sitting on the board of directors of Jimco. So if this disclosure is made, then it is fine. If the disclosure is not made, then there is a violation of this standard. The investment management firm of D&R sells a 25% interest in its partnership to a multinational bank holding company, First of New York. Immediately after the sale, Roy Hobbs, president of DNR, changes the recommendation for first of New York's common stock from sell to buy. Okay, so you have sold a 25% interest to a particular company and you are writing a research report on this particular company. You are changing a recommendation from sell to buy. Adds first of New York's commercial paper to DNR's approved list of purchase. So it's not related to equity, it's related to commercial paper. So the best practice would be for Hobbs to discontinue research coverage of First and New York because the new ownership interest in the company creates a conflict of interest. Even though you're still writing a research report, you must disclose this conflict so that you are giving optimum chance to your clients to evaluate, sorry, evaluate whether there is any kind of potential biases in your research. Standard 6B priority of transactions. We have already discussed that, first comes your client, then is your employer, and then it is your personal self transactions. So if I'm writing a research report and I'm recommending a particular stock, let us say Britannia, so I will give my clients the first chance or the opportunity first to them in order to buy the share. After giving them sufficient amount of time to take a decision, then the next person who will be allowed to trade on this particular recommendation will be my employer. After giving sufficient time to my employer, if my company allows me to trade, then I may buy it in my personal portfolio as well. But if the company is not allowing you to buy the shares that you are recommending, then obviously you will not be allowed to do any kind of transaction. Then comes family. So you must first check if your family is a client or not. If your family is a client, then they must be treated at par with the client. If your family is not the client, then your family comes first. So you must allow your family to make the purchases after you have given sufficient time to your employer. Now, in the stock market, it can happen that let's say I'm recommending the stock of Britannia, let's say at a price of 5,000. Now, it may happen that when the client is purchasing the stock it at 5,000, I have given them sufficient time and the first opportunity. Later on, after let's say sometime or a couple of days, when my employer wants to buy the stock, they are getting it at a price of 4,950. And then after I've given time to my employer, I am buying the share, I am getting it at 4,920. This is absolutely fine, even though the client is buying at a higher price, but I'm giving them the first opportunity to buy. It should not happen that I am trading first and I am doing a kind of front running. That means I'm buying before the client. So people are getting different prices. I don't have any control over it. It can also happen that one of my client, Mr. A, is getting it at 5,000. One of my another client B is getting at 4,950. Another client C is getting at 4,920. Different prices are fine because the prices are not in our country. So client transaction must take precedence over the employees or members' personal transaction. Personal transactions are the transactions in which member has a direct or indirect personal interest. Personal transactions may be undertaken only after when the client and the employer has adequate time to act on the recommendation. Now over here, CFA Code of Ethics does not prescribe the time. They are not saying 2 hours, 2 days, or 2 weeks. The adequate time, it depends on the firm and it depends on your personal discretion. Personal transactions should never adversely affect clients or employers' investments. And we have already seen how family members' transactions are to be treated. The research analyst Long does not recommend the purchase of a common stock to his employer's account because he wants to purchase the stock personally and does not want to wait till the recommendation is approved and the stock is purchased by his employer. So you are also breaching a loyalty and you are also breaching a priority of transactions because you want to do front running. You want to buy the share before the employer and the client. It's a simple case of violation. Example two, Baker, a portfolio manager of an aggressive growth mutual fund, maintains an account in her husband's name at several brokerage firms, with which the fund and a number of Baker's other individual clients do a substantial amount of business. So your husband is a client, treat him as a client. Whenever a hot issue becomes available, she instructs the brokers to buy it for her husband's account. Because such issues normally are scarce, Baker often acquires share in hot issues, but her clients are not able to participate in them. So you're treating your clients unfairly over your husband. You are violating priority of transactions. So if your husband is a client, treat him as a client. If your husband is not your client and you are managing it on your personal account, first you should allow your clients to trade and then you should allow your husband to trade, or you should do transactions for your husband's account. You must also disclose the trading for your husband's account to your employer, because this activity creates a conflict with her personal interest and the employer's interest. So there is also a conflict of interest which must be notified to the employer. So what they're trying to say is, if your family is not your client or is not a client of your employer and you're trading in the account of your family, you have to notify this to your employer, because again, this is a conflict of interest. Standard 5C referral fee. If I'm getting any kind of direct indirect benefits for recommending certain investments or let's say insurance policies or mutual fund schemes, I have to notify what fees or I'm getting in order to make this referral. So members and candidates must disclose to the employer, clients and prospective clients. So you have to notify each and every one of them any compensation, consideration or benefit received, paid, other paid to others for recommendations of product or services. So you may be receiving benefit or you may be paying benefit to somebody to recommend certain products and services. Everything must be disclosed. Disclosed to whom? Employer, clients as well as prospective clients. Members must, before entering into formal agreements, disclosed to the clients and prospective any benefits received or given for recommending any services by the members. You must also disclose the nature of the benefit. So whether it is monetary, non-monetary, you must disclose the referral fee as well as what you are getting in return. So James works for the trust department of Central Trust Bank. He receives compensation for each referral he makes to the trust brokerage department and personal financial management department that results in a sale. You're referring several of the client to the personal finance management department, but you're not disclosing the agreement with Central Trust to his clients, so you are in violation. So whatever referral fees you are getting, you must disclose it to the client before you enter into an trading arrangement with them. The disclosure should also include the nature and the value of the benefit, and it should be made in writing. So it should be the nature as well as value of the benefit, and this information should be given in writing. And the records also must be maintained. Catherine Roberts, portfolio manager at Katama Investments advisory firm specializing in managing assets for H&I. The trading desk uses a variety of brokerage houses to execute trade on behalf of the client. Roberts asked the trading desk to direct a large portion of its commissions to Noshan Incorporation, a small broker-dealer run by one of Roberts' business school classmates. So traders have found that it is not very competitive on pricing, though Noshan generates some research for trading clients. Other analysts have found most of Noshan research not to be especially useful. So you are asking your firm to direct certain trades to a particular broker, and the broker is giving certain kind of research, but the research is not that good and the pricing is not even competitive. Nevertheless, traders do as Roberts asked, and in return for receiving a large portion of Katama's business, Noshan recommends the investment services of Roberts and Katama to its wealthiest clients. This arrangement is not disclosed to either Katama or the clients referred by Noshan. So it's a simple case of violation of referral. So even if you're getting any kind of research, any kind of monetary, non-monetary benefits, even though the research is going to benefit the client, you must still disclose that we are directing your trades to this particular broker. The prices are not very competitive, but we are getting some kind of research in general. Okay, so last standard 7A. 7A is applicable to you and me, and you have to be very careful over here because it is applicable to the participants in the CFA program. So it is talking about conduct, how you should behave as participants in the CFA program. Members and candidates must not engage in any conduct that compromises the reputation or integrity of CFA Institute or the CFA designation or the integrity, validity or security of the CFA Institute programs. Conduct covered includes cheating in the CFA program or any other examination. Now, if you are a CFA candidate, you cannot cheat in the CFA exam. You cannot even cheat in your BCom, MBA, or PGDM examinations or any examinations that you give. Because see, if you're cheating in other exams and somebody files a report against you in the CFA Institute, it reflects that if you're cheating over there, you have a potential to cheat in the CFA program as well, and you lack integrity as an individual. So you're not allowed to cheat in any other examination. If you disregard or if you don't pay attention to CFA's examination policies, you are in violation. So earlier, when the exam used to be in a paper and pen format, when they are asking you to put the pens down, stop writing, you have to stop writing literally over during that time. If you are just trying to, complete a sentence like we do in our local schools and colleges, you are assuming to be in violation of standard 7A. Disregarding the security. So if you get into fights with any of the security or with the proctor or the examiner, then you will be in violation. Improperly using the CFA charter for personal or professional gain. So if I say to my clients that I'm a CFA charter holder, my competitor is not a CFA charter holder, I'd be able to give better service than him. My research will be more reliable. My prices are more competitive, or I am charging you higher just because I'm a CFA charter holder. All that will be conducted as a violation of standard 70. Misrepresenting any information in the PCP. So whenever you are filing any kind of documentation with the CFA Institute, while you are registering for the exam or applying for the charter or wanting to continue with the charter, if you give any false information, you will be violating under misconduct. So this standard is a subset of misconduct, and it is the preferred option over misconduct in the CFA program. So you are also violating misconduct, but if it is related to the CFA program, you are violating this particular standard and not the misconduct. This standard does not stop anyone from expressing their opinions about CFA Institute or CFA program, and the members are free to agree or disagree with the CFA Institute policies and procedures. So I can make comments like, the CFA Institute has increased the fee. It just wants to like collect money from students, or the past ratings has gone down. The CFA Institute is making students appear for the exams more number of times. So I can make any kind of supporting comments or negative comments about the CFA Institute. It's just my opinion. Okay, but I cannot, disregard the policies of the CFA program. So I cannot leak any examination questions, or let's say I've gone and given the examination. I cannot come back and say my friend staying in some other country that, okay, study this topic and go. It's an important topic. I received these kind of questions. So I cannot violate any of the policies of the CFA Institute, but I'm entitled to my opinion as such. So Travis serves as a proctor for the administration of the CFA examination in the city. In the course of a service, he reviews a copy of the level 2 CFA exam on the evening prior to the exam's administration and provides information concerning the exam questions to two candidates who will prepare for the exam. So there is a person and he is leaking the exam questions that will come tomorrow. So both this person who is leaking and the two candidates who have relied on the information that they have received, everybody is in violation. Okay, so even the person leaking the information and the person receiving the information are in violation, because the person receiving the information are CFA candidates. Sullivan is enrolled to take the CFA Level 2 exam. He's been having difficulty remembering a particular formula. So prior to entering the exam room, he writes the formula on the palm of his hand. This is straight away a violation. During the afternoon section of the formula, proctor notices civilian looking at the palm of his hand. She has to see his hand and finds the formula. So obviously, this particular candidate is in violation. They will file a report and there will be an inquiry. So you are not allowed to talk to anybody while you are in the exam room. You are not allowed to peek into anybody's answer paper or computer screen now while they are giving the exam. Obviously, you are not allowed to chit chat, make any kind of verbal, non-verbal expressions as well. So, refrain from looking at anybody, talking with anybody, making any kind of comments or, any kind of expressions like giving somebody a best of luck or asking somebody how they are doing in between the exams. So don't do these kind of things while you're appearing in the CFA exam, and adhere to the similar practices when you're giving other exams as well. So at the conclusion of the morning section, the proctor announces stop writing now. So when they announce stop writing, so stop writing, don't even click the mouse or, randomly start filling the answers to the questions that you have missed. So don't do all that. Stop writing means stop writing. John Davis has not completed the examination, so he continues to randomly fill in ovals in the answer sheet. A proctor approaches desk and reminds him that he should stop writing immediately. Davis, however, continues to complete the answer sheet. After the proctor asks him to stop writing 2 additional times, Davis finally puts down his pencil. So he is taken undue advantage and he has taken additional time to complete the answers, and this is unfair policy. Even after hearing the proctor's instructions, he has violated the rules of the CFA program. So level 1 candidate has been a frequent visitor to an internet forum designed specifically for CFA program candidates. The week after completing the level 1 program, they and several others began a discussion thread in the forum about the most challenging question and attempt to determine the correct answers. So you're not allowed to discuss any particular subject, any topic, any formula that may or may not be tested in the exam. So, the group discussion about exams that has already happened is also confidential, and the entire group is in violation. Prior to participating in the exam, Whitcomb is required to sign a CFA Institute grader agreement. As a part of grader agreement, Whitcomb agrees not to reveal or discuss the exam materials with anyone except CFA Institute staff or other graders. So somebody is appointed to be a paper checker. So they are not allowed to disclose any information that they gather during the process. Several weeks after conclusion of the exam grading, Whitcomb tells several colleagues who are candidates for the CFA program which questions he has graded. He also discusses the guideline answers and adds that a few candidates score well on the question. So a lot of people, candidates, exam proctors, paper graders, paper setters, they are not allowed to leak any confidential information. Standard 7B, how you are referring to the CFA Institute, the designation and the CFA program. Now if you are a level 1 candidate, you can only write CFA level 1 candidate. You cannot write CFA, put the CFA degree after your name, CFA charter of your name if you do not have a valid charter. If you have completed level 1, you cannot say that you have completed level 2 or level 3. And you cannot say that just because you have completed CFA, you will be delivering better results compared to somebody who has not done this program. So you cannot claim any kind of these superior results. When referring to CFA Institute membership or the designation of candidacy, members or candidates must not misrepresent, must not exaggerate, or imply any kind of superior returns or superior service to your clients by holding the CFA designation or candidacy of the CFA program. Once accepted as a CFA Institute member, the member must satisfy the following conditions. You must annually sign the PCS. You must annually pay the membership fee. I do both of these things. If not fulfilled, you cannot represent yourself as a CFA Institute member. Now, if I continue to put the CFA tag after my name, even though I'm not paying the membership fee, and I'm representing or presenting myself as a CFA charter holder on LinkedIn, CFA Institute will immediately send me a mail stating that I have not paid the membership fee. If I continue using the CFA designation, I'll be in violation of the code of ethics. So I have to remove it. Now, sometimes it may happen that people may forget to pay the fee. So either they pay the fee and continue using the tag, or if they do not want to pay the fee, they have to remove the CFA charter after that name. Members must not make promotional efforts or promises or guarantees that are tied to the CFA designation. Just because I've completed my CFA, I'll be able to achieve superior returns compared to my industry peers. Those kind of statements are not to be made. Members must not overpromise the competency of an individual. They must not promise to deliver any kind of investment results. Members must clearly state that they are candidates in the CFA program and there is no partial designation. So I cannot write Krishnan and put CFA level 1. Okay, so there is no, tag like this. So I can write CFA level 1 candidate or I can write CFA level 1 cleared. Now, there are some people who write inter CA, okay, or CA finalist. So I'm not allowed to make these kind of statements. I cannot write inter CFA. I cannot write CFA finalist. I can just mention either I'm a CFA charter holder or if I've cleared a particular level or I'm a candidate at a particular level, I have to mention that. The charter financial analyst or CFA marks must always be used either after a charter's name or an adjective, but never as a noun. So I cannot say that I am Christian, the CFA. Okay, or I cannot say that I am CFA and I am Krishna. So instead of using Mr. Krishnan, I cannot write CFA Krishnan or as such. So CFA should not be used as a noun. The CFA is a tag which I use as a suffix, but it should not be a part of my name. An advertisement for AZ Investment Advisors states that all the firm's principals are CFA charter holder and all have passed the 3 exams on the first attempt. So CA candidates usually write this in the LinkedIn profile. I've cleared all my CA, inter, and final in my first attempt. But CFA candidate are not allowed to make these kind of statements. They are not allowed to make these kind of statements, especially to imply that they are superior, compared to others who have taken multiple attempts to give the exam. The advertisement promptly links to the fact to the notion that AZ's mutual fund have achieved superior performance. So AZ may state that all principals have passed the 3 exams on the first try as long as the statement is true, but it must not be linked to imply any kind of superior ability. Five years after receiving CFA charter, Louis resigns his position as an investment analyst and spends the next 2 years traveling abroad. Because he is not actively engaged in the investment profession, he does not file a PCS with the CFA Institute and does not pay his membership dues as well. At the conclusion of his travel, he becomes self-employed analyst, accepting assignments as an independent contractor. Without reinstating his CFA Institute membership by filing his PCS and paying the due, he prints business cards that display CFA after his name. So before filing the PCS and paying the membership fee, he cannot use this time. Now it may happen that in the year 2026, I decide to take a career break and I decide not to pay the CFA Institute membership fee. So I cannot put CFA after my name in the year 2026. But in the year 2027, after I decide to resume my work, I have to sign the PCS, I have to pay the membership fee, then only I can put the CFA tag after my name. So these are some of the correct and incorrect methods of representing yourself. He is one of the 2 CFA charter holders in the company. So this is fine. You are using CFA charter holder as an adjective. He is one of the 2 CFAs. Your CFA is used as a noun, so you cannot use it as a noun. You cannot use it as a noun. You cannot use it as a noun. He earned the right to use the chartered financial analyst designation. Again, so this is an adjective. He is a chartered financial analyst. This is used as a noun. Now, many people do this mistake, but they should be very careful not to do this. Jane Smith, CFA charter holder. So CFA does not have C.F.A or it's not written in very much. So I'm writing my name as Jane, and I am after Jane I am writing CFA in such a big letters. So this is also not. I cannot write it in small. I cannot put any kind of full stops or periods over here. So, these kind of writing or representing CFA in these manners is incorrect. CFA, you can put the register mark over here and you can write CFA charter holder. John is a CFA type portfolio manager. There is no CFA type. And then CFA equivalent program is also not there. Swiss CFA is not there. Indian CFA is not there. Okay, CFA is only one. You cannot add or create any new word or phrases. Jane Jones, Chartered Financial Analyst. You cannot use Chartered Financial Analyst in corporation. The designation must not be used as a part of the name of a firm. The CFA designation should not be given more prominence. Over here, they are trying to write CFA in a very bold letter or, they use a different color or use a different text size. Level 1 candidate in the CFA program, you are allowed to represent yourself in this manner. So Chartered Financial Analyst, September 2011. Now people have the habit, if they are going to clear their MBA in 2027, they used to write it in this way, MBA 2027. So if I'm expected to get the CFA charter in the year 2027, I cannot write it. I cannot put the CFA tag. I can only write CFA all 3 levels clear or CFA level 3 cleared, CFA level 2 cleared, CFA level 3 candidate, etc. So candidate must not cite the expected date of completion or expected date of awarding the charter. So CFA level 1, CFA degree expected in 2011. So CFA is not a degree, it's just a professional certification. It should not be referred to as a degree. It's not your BCom, MCom, MBA, etc. You can write, I have cleared CFA level 1 and in the year 2010. You can write it in this way. I have cleared all the 3 CFA levels and I may be eligible for the charter upon completion of the required work experience. I cannot write CFA past finalist. I cannot write inter CFA. I cannot write CFA finalist. CFA 2009, CFA Society of the UK. This is incorrect. I must not put this. There is no year in which you have received the charter as well. So in citing the designation in the resume, the charter holder should not use the date that he or she has received the designation and should not cite CFA Institute as a conferring body. So it is better that write your name. If you have the CFA charter holder, write CFA and put this answer. So an investment firm has published an advertisement that states that all firms principal are CFA charter holders and have passed the exam in first attempt. The advertisement relates to superior performance of the firm to the above part. So superior performance is incorrect. You can make this statement in general, but you must not imply any kind of thing. So this is a violation. Member puts a CFA logo on his business card, allowed letterhead and the company letterhead. Personal is fine, but company letterhead is not allowed. So he has violated the standard. You can use it for your name. If you are a freelance analyst, you can use it in your personal letterhead. That's also fine, but you cannot use it in your company's letterhead. So we are done with the code of ethics. The next chapter is on GIPS. So we'll take a 5-minute break and then we'll start with this chapter. If you have any questions, you can ask me. Otherwise, 5-minute break. Now, next chapter is the Global Investment Performance Standards. It mostly refers to how we present performance of a particular asset management company to the clients and to the prospective clients. So this is something that is applicable to performance reporting. And it is applicable only to asset management companies. It is not applicable to research firms. It is not applicable to software manufacturing firms. It is not applicable to any of the stock exchanges. Okay, it is applicable only if your business is into asset management. Okay, so over here, how these asset management companies will report their performance. So let's say in the last 5 years, I have generated how much percentage of return. So let's say I've generated 8% return. How this 8% is calculated, what is the methodology that is to be used, and what is the input data that we have to take, etc. So all this information will be given to you by GIPS. You can adhere to their standards, their reporting standards, their norms, and you can present your performance and state that the performance presentation reports are prepared in accordance with GIPS or in adherence to GIPS. So why GIPS were created? The problem before GIPS, earlier each investment firm used its own method to report performance. Now there are many methods to report performance. You can use arithmetic mean, you can use geometric mean, you can use IRR, XIRR, etc. So firm, what they used to do is they used to do all these calculations, and then let's say if the arithmetic mean is the highest, then I'll report using the arithmetic mean. And let's say I have 5 portfolios, and out of these 5 portfolios, 4 are profit making, 1 is loss making. I'll exclude this and I'll calculate the average only based on the winners. So, these kind of manipulations or malpractices used to happen. So that is why GIPS were created. And if I want to compare one firm that is manufacturing assets, that is managing assets in the US, and one firm that is managing assets in the UK or in the Germany, I'll be able to compare their performance measures if they are both adhering to GIPS. So it is just like having IFRS, having US GAAP, having Indian accounting standards, so that whatever data is presented, that data is comparable across firms. Because firms use different calculation methods, investors could not compare firm A versus firm B. One firm's 12% return might not be calculated the same way as another's 12% return. The comparisons became meaningless. And there used to be some biased performance reporting. That means we used to exclude exclude portfolios that are given negative returns, or we used to exclude clients who have left the firm. So the common tricks that were used is cherry picking, showing only the best performing portfolio, claiming that it represents the firm's overall performance, we exclude or ignore terminated account, or we exclude clients who have left us, and we have excluded accounts that are closed by unhappy investors. So we used to report only the good years, we used to hide bad years, and then the performance information was totally misleading. So to overcome all this, GIPS was created. So GIPS solves these problems by providing a standard methodology. The rules applies to all the firm, the same calculation method everybody will be using, and they will be using the same reporting structure. So this ensured fair performance reporting, full disclosure, and comparable results across firms. So this is the advantages or importance of GIPS. Benefits of making the report standardized. Okay, it is helpful to make meaningful comparisons across firms and across time periods as well. You reduce any kind of misrepresentation, you improve transparency, and it helps regulators understand how much return is earned and how much risk were taken by the firm. Now, which firms can claim compliance? Only those firms that manage assets for others can be GIPS compliant. That means you have to be an asset management company or a portfolio management company or an investment advisory firm that is managing clients' money. So managing money is very important. Who cannot claim compliance? If you are not into managing assets, you cannot claim compliance, such as software provider, data vendors like money control, performance measurement systems, etc. They may say that they endorse GIPS, but they may not claim compliance. So these firms can endorse GIPS, but they cannot claim compliance with GIPS. And also GIPS compliance is voluntary. It is not mandatory. It's not compulsory. But if a firm is asset management company seeking compliance, it must be fully compliant. It must not claim partial compliance. And it must be compliant on the entire firm and not only for specific portfolios, specific geographical locations, etc. A firm cannot say that only this fund or only this portfolio is GIPS compliant. The GIPS compliance must be applicable for the entire asset management firm. Who are benefiting from GIPS? Clients, prospective clients, investors, and regulatory bodies. They are able to evaluate the performance of the firm and they are able to take investment decisions. They are able to decide whether they want to use this firm as the stockbroker, as the portfolio manager, etc. So these are the key concepts of GIPS standards. So you have to remember these standards. So GIPS standards are divided into 8 sections. CFA Code of Ethics had 6. GIPS are having 8. First is fundamentals of compliance. So the firm must be clearly defined what is the scope of operations, what exactly the firm is doing, which all different geographies they are based, what kind of assets they manage. And they must provide GIPS compliance report to all the clients as well as prospects, not only to the selected one. Or you cannot say to the client that if you pay me, then I'll give you a GIPS compliance report. It should be given to everyone. So you have to follow local laws and regulations, and you have to ensure that the report is free from any kind of misleading information. You have to be very consistent with the data that you use. You have to be consistent with the calculation methods that you use. And there's a standardized methodology which is applicable to all the firms. The next is a composite. So yesterday I've given you this example. Composite means it is a group of portfolios that are managed as per a specific mandate. So if a portfolio is invested 50% in equity, 50% in debt, all portfolios following this particular strategy, whether they are discretionary, non-discretionary, whether they are continuing or discontinued, will come under one composite. Another composite can be 50% equity, 40% debt, and let's say 10% crypto. This will be coming under one particular composite. So the composite must be asset weighted. That means, let's say if one portfolio is having 100 million, other portfolio is having 200 million, that means this will have a weight of 67%. This will have a weight of 33%. And they cannot cherry pick portfolios. They have to include all the portfolios, whether they are making profit and loss, continued or discontinued. And the pool funds must be included if they fit a composite definition. So you have to decide this portfolio will be included in which composite. Will it be composite A, composite B, or any other composite before you decide to include it in the performance. It should not happen that, I have created a portfolio and the portfolio has generated positive returns. This composite is having negative return. So let me include this portfolio over here so that I am able to, upscale my particular returns by some amount. So the composite must be decided before the performance is calculated. So this I just mentioned, there is not much explanation is given. So it should be a composite time weighted returns. It should be a money weighted return. So all this you will learn in your portfolio management. What is time weighted average? What is money weighted average? So then time weighted, that means we are going to use IRR or XIRR. And pooled fund is just like a mutual fund in which money is pooled from the investors. Composite can be individual portfolios of clients or institutions. Then pooled fund money weighted returns as well. So this is how returns are going to be calculated. These methods are going to be used. Methods will be discussed in portfolio management or in quants. This includes required disclosures, recommended disclosures, and you can claim compliance only if you are fully compliant. So you can advertise yourself as being compliant with GIPS, but you can use this advertisement only if you are fully compliant firm-wise to the GIPS. And the advertising guidelines ensure that the ads are not misleading. Like in India, if you are having a mutual fund or if you're promoting or setting an advertising of any mutual fund, you have to follow AMFI guidelines and SEBI guidelines so that, no mutual fund is giving any kind of misleading advertisement. So they are now going to explain a composite. A composite is a grouping of discretionary portfolios with the same investment strategy, objective, or mandate. So discretionary means the portfolio manager has a say on where the money will be invested. So it's like a mutual fund in which portfolio manager takes the investment decision. So example of a composite, large cap equity portfolio. So if a portfolio is investing money only in large cap equity, then it will be a part of this composite. If it is investing only in investment grade bond, it will be a part of this composite. If it is an ETF or index replicating portfolio, it will be a part of this composite. So composites are important because they prevent selective reporting. So, firms will not be able to group portfolios belonging to different composites together and quote a particular return. It shows true performance of a strategy. So firms will be able to determine that, okay, I am the market leader, or this is the area where my portfolios are generating superior performance, and this is where I need to work on. So true performance of a strategy, which strategy is working. It can help the clients evaluate where is the exact skill set of the manager lying, what is the investment style, are they consistent in making their investment approaches, and where the skills of the manager is lying. So we can say that the manager is really good at managing large cap portfolios. The index replicating portfolio manager may be not doing a good job. So it must include all fee paying discretionary portfolios. This is very important. So non-fee paying, non-discretionary portfolios may not be included over here. So it's a regulation or a rule which you must remember. It must include both current and past portfolio. Even if the client has left you, you may still have to include the portfolio while calculating returns. I've already explained this. The portfolio is assigned to a composite before the performance is known or before the return is calculated. Every discretionary portfolio must belong to at least one composite. So there cannot be portfolios that are not a part of any composite. So moving on. In fundamentals of compliance, the firm must be defined as an entity. It should be presented to the clients as a single business. It must include all geographical locations wherever they are operating. If Bluestone Advisors operates in Mumbai, Delhi, and Singapore, all must be included in the firm's definition. So Bluestone Advisors will be, recommended or represented to the clients as Bluestone Advisors. It will not be represented as Bluestone Advisors Mumbai. It will not be advertised as Bluestone Advisors Singapore. So GIPS compliance must be for Bluestone Advisors operating under different geographical locations. Discretionary portfolio, I've explained you this. Portfolio is discretionary if the manager can implement the intended strategy without client's restriction. So the manager has decision taking power. The portfolio is non-discretionary if the client restricts or prevents execution of the strategy. Such portfolios are excluded from the composites. So non-discretionary portfolios are not included in composites. Now, GIPS is a small chapter. You can expect some questions from this chapter, but most of your questions from the code of standards. Now, after you have claimed compliance, you can approach a third party who will verify and who will submit an audit kind of a report to say that are you in compliance with GIPS? Have you followed all the standards properly? So it's a third party review. Verification is a third party review of GIPS compliance. It applies to entire firm. And then again, this is optional. It is not mandatory. So is verification mandatory? No, but it is strongly encouraged. What does the verifier confirm? The verifier confirms that the firm has created the composites properly and the firm has followed the calculation methods. It has taken all the required input data and even the presentation is correct. So they will give you this kind of a disclosure for firms that have been verified independently. You'll put the firm name as being verified for the period. You'll put the date and the verifier will even write it. The copy of the verification report is made available upon request. So GIPS compliance is voluntary, but it is all or nothing. That means you have to be compliant throughout all the principles. You cannot claim partial compliance. The compliance is firm-wide. It prevents cherry picking of portfolios that have superior performance. The verification is not an endorsement of the performance quality. That means just because I'm getting it verified from a third party, I'm only verifying GIPS compliance and not my performance as a asset management company. And only asset managers, companies can claim compliances. Software developers, research firms who are not managing money cannot claim compliance. So which of the following statements regarding GIPS compliance is correct? Asset owners that manage assets can claim compliance with GIPS standards. Okay. Regarding GIPS is correct. Software that calculates performance in a manner consistent with GIPS can claim compliance. So software cannot claim compliance. Firms can comply with GIPS standards by limiting their compliance claims to the provisions they have chosen to follow. So you cannot choose, you have to be compliant throughout. So asset owners who manage assets, you can claim compliance with the GIPS standards. Which of the following cannot claim compliance with GIPS standards? So they're asking cannot. Investment management firms can. Pension funds can. Software vendors cannot claim compliance. So the answer is software. So James is an investment analyst for a major Wall Street brokerage firm. He works in a developing country with rapidly modernizing economy and a growing capital market. The local security laws are minimal. That means he has to follow stricter law. He has to follow CFA Code of Ethics and include no punitive prohibitions against insider trading. So insider trading is allowed in this particular economy, but CFA prohibits. So he has to follow code of standards because code of standard is more strict. So if he comes across any material non-public information, then he must follow standard 2A material non-public information. He must not act, he must not cause others to act on this information as well. So even though local laws are not very strict, you still has to follow code of ethics. Amanda is employed as a fixed income portfolio manager for a large international firm. She's on a team within a firm that is responsible for creating and managing a fixed income hedge fund to be sold throughout the firm's distribution centers to high net worth individuals. Her firm receives expression of interest from potential clients from the Middle East who are seeking investments that comply with Islamic law. The marketing and promotional materials for the fixed income do not specify whether or not the firm is suitable investment for an investor seeking compliance with Islamic law. So they are not sure whether whatever hedge fund they are promoting is coming under the Islamic law. Because the fund is being distributed globally, Jenny is concerned about the reputation of the fund, and the fund believes disclosure of whether or not the fund complies with Islamic law could help minimize potential mistakes with placing this investment. So they are creating a fixed income portfolio or a fixed income hedge fund. They have to understand various law. If somebody is coming and asking, is it under compliance with Islamic law? You have to understand Islamic law, then only you will be able to come up with a statement. If you do not have the capacity or the competency to evaluate the Islamic law, you can take an external help. But without verifying or without having any kind of compliance, you cannot come up with any kind of statements. So Jani and the firm could be proactive in their efforts to acknowledge areas where the new fund may or may not be suitable with their client. So you must be aware of the cultural and religious laws if required. Bloom is a junior portfolio manager for a high net worth portfolios at a large global investment manager. She observes a number of new portfolios and relationships coming from a country in Europe where a firm did not have previous business and is told that a broker in the country is responsible for the new business. At a meeting on allocation of research resources to third party research firms, Bloom notes that this broker has been added to the list and has allocated payments for research. However, she knows the portfolios do not invest in securities in the broker's country, and she has not seen any research come from this broker. So they are just paying the broker without receiving any kind of research. So there might be some money siphoning going on. Bloom asked the supervisor about the name being included in the list and is told that somebody in marketing is receiving the research and the name being in the list is okay. She believes that what may be going on is the broker is paid for new business through inappropriate research payments and she wishes to disassociate from the misconduct. So some kind of money laundering is going on and she wants to disassociate with herself from the misconduct. She has taken up this up with the supervisor, so she has followed the first step. But because the supervisor has not given a proper response and this activity seems to be a bit unethical, she wants to disassociate herself from the activity. So she is actually complying with what is required. White is excited to use new technology to communicate with clients and potential clients. She recently began posting investment information, including performance report and investment opinions and recommendations to her Facebook page. In addition, she sends out brief announcement opinions through her X account. Okay, for example, prospects of future prospects of XYZ look good. Prior to White's use of this social media platforms, the local regulator had issued new requirements and guidance governing online electronic communication. So before communicating on any social media platform, she has to check what is the local regulator saying. Which communication appeared to be in conflict with the recent regulatory announcements. So she should not continue sending these kinds of messages in her social media. She should adhere to the local regulatory standards because it is more strict. If she doesn't comply, then she is in violation. So Fritz has concluded that metals and mining stock is overvalued at the current level, but he is concerned that a negative research report might jeopardize a close rapport that he has nurtured over the years with metals and mining CEO. So he is preparing a research report. He knows that the stock is overvalued, but he is concerned that it might jeopardize his relationship. So if he, succumbs to the pressure, then he is violating independence and objectivity. He is concerned that a negative report might also result in management retaliation, for example, cutting him off from participating in conference call. So he should not worry about all this because if he is thinking that he will not be included in the conference call, it is okay. But he has to be very thorough and independent in what research recommendation he is giving. So if he succumbs to all this pressure, he is violating independence and objectivity. Syed is the president of investment management firm. The promotional material for the firm created by the firm's marketing department incorrectly claims that he has an advanced degree in finance from a prestigious business school in addition to the CFA designation. So he comes to know, if he comes to know that he is being wrongly presented, he has to take immediate corrective actions. If he doesn't come to know, then it is fine. Although Mohammed attended the school for a short period, he did not receive a degree. Over the years, he and others in the firm have distributed this material to numerous prospective clients and consultants. So you have distributed a wrong content in which you have been misrepresented, so you will be held accountable. So Abdrabu manages the investments of several HNIs in the US who are approaching retirement. He advises these individuals that a portion of the investments be moved from equity to bank sponsored certificate of deposits and money market account so that principal will be guaranteed up to a certain amount. Now, even though interest is not guaranteed, these are bank sponsored certificate of deposits. So even in India, if you're holding money with any of the banks, it is not a guarantee. The banks can still default. But there is some kind of deposit insurance which RBI promises that, okay, let's say you are not able to recover money from this particular bank because the bank has become bankrupt or run into some financial crisis. Your deposits are, let us say, secured up to 5 lakh rupees. So even if you have a fixed deposit of 10 lakhs, you might receive a return of 5 lakhs under the deposit insurance scheme. So principal is guaranteed up to a certain amount. It is fine, but it is not guaranteed by the bank. It is guaranteed by the government or the depository insurance. So in this case, it is not inappropriate as long as the amount is within the government insured limit. The person should also explain these facts to the client. So he's not making any wrong statement. He's making a correct statement. It is guaranteed up to a certain amount. The certain amount, a certain word is important over here. Entire principal is not guaranteed. It is only a safe up till a particular amount. And the interest is not guaranteed. He is right about that. So there is no misrepresentation happening over here. Glusker is a regulatory attorney for a hedge fund who sought to transition to sales after was transitioned to a sales role after impressing senior management with a strong business acumen. There is a licensing requirement involving an examination that an individual must first pass before being qualified to serve as a sales manager. There's also knowledge of the law. Among other things, the examination covers technical rules and regulations designed to ensure fairness while dealing with clients and prospects. Glusker was not familiar with these rules and regulations because he was never asked to provide guidance of them as a regulatory attorney. He did not learn the material or study the exam or study for the examination, and instead relied on his industry knowledge to receive a passing score. So he has violated competence because if you are asked to complete certain certification requirements, you have to study for the exam and you have to be well aware of what is the rules and regulations. So if he doesn't do that, and even though he receives a passing score, it's still not very relevant because he has not studied for the exam completely. Evans is one member of a 5-person team of an analyst at a boutique research firm providing independent research to buy-side firms. Primarily covers the energy and transportation sector. Boss leaves the firm to return to academia. So boss leaves the firm to return to academia. Firm's management promotes Evans to director of the research. Okay, so you are getting promoted because your boss is left and he hires 2 junior analysts to replace her. Evans now has supervisory responsibilities of 4 analysts and is responsible for all the research produced by the firm. Prior to a promotion date, Evans spends a great deal of time and effort getting up to speed on the research reports of the firm that she was not involved in. Although she has never directly managed others in the past, that he does not spend time becoming familiar with effectively managing employees. So if you are promoted to become a supervisor, then you have to have the qualities that are required to be a supervisor. You have to develop the competence. You have to learn how to manage a team. You have to you have to learn about the different compliance that are required from your subordinates as well. So even though you are spending time in improving your research skills and reading about research reports that you had not covered earlier, but you must also improve or increase your competence with regards to managing your subordinates. So for that, if you are requested to do some course, attend a program or a conference, you are supposed to do it. Standard 2A, material non-public information. Elizabeth is based in Hanoi and covers the Vietnamese market for a firm which is based in Singapore. She is invited together with other 10 largest shareholders of a manufacturing company to meet the finance director of the company. During the meeting, the finance director states that the company expects its workforce to strike next Friday. So this is sensitive information. The sensitive information is disclosed only to 10 largest shareholders and to this particular person. So this is selective disclosure. It's not public information. And this is going to cripple production and distribution. So this information is material as well as non-public. So you are not allowed to use this information unless and until the company releases a press statement. So if the company has not made this information public, you cannot use this information. So Fetchman is trying to decide whether to hold or sell the shares of an oil and gas exploration company that she owns in several of the funds she manages. Although the company has underperformed the index for some times already, the trends in the industry signals that the company of this type might become a takeover target. Okay, so there's a good chance that this company will be taken over in the future. While she is considering a decision, her doctor, who casually follows the market, mentioned that she thinks that the company in question will soon be bought out by large multinational conglomerate, that it would be a good idea to buy the stock right now. So a doctor is giving her an opinion. So she should not rely on the doctor because he might not have the competence to do a independent and thorough objective research. So she must follow certain kind of due diligence as well. After talking to various investment professionals and checking their opinions on the company as well as checking the industry trends, Fetchman decides next day to accumulate more stocks in the oil and gas exploration company. So, although information on an expected takeover bid may be of the type that is generally material and non-public, in this case, the source of information is unreliable. It's not a material non-public information, it's an unreliable source of information. So Fetchman is not prohibited from trading the stocks on the basis of this information, but you must definitely do some research and follow some due diligence before you decide to invest money in this company. Shaker manages two funds, equity fund, a balanced fund, whose equity components are supposed to be managed in accordance with the same model. According to that model, the fund's holdings in stocks of a particular company are excessive. Reduction of the DD holdings, however, will not be easy. However, because the stock has low liquidity in the stock market. So more money is invested over here. The problem is low liquidity. Low liquidity means you will not be able to easily buy and sell because the counterparty will not be available. So if let's say I want to buy 1 lakh shares of this company, there will not be any person who is willing to sell me 1 lakh. If I want to sell 1 lakh, there will not be a buyer over here. So that's why the liquidity is less. So Shaker decided to start trading larger portions back and forth between his two funds. So what he is trying to do is he is trying to artificially inflate the trading volume and the price. That is market manipulation. He is in violation. He believes market participants will see the growing volume and increasing price and becomes interested in the stock. So he is manipulating price and volume, and the intention is also to mislead the participants. So if demand is generated, he will be able to get rid of at least some of the stock overweight position without introducing price decreases. So there is a violation, market manipulation. The intention is to mislead. Now, in this way, the whole transaction will be for the benefit of the fund. So even though it is going to benefit your client, you cannot engage in market manipulation activity. VIDA manages portfolios of number of HNIs. Major part of our investment management fee is based on trading commissions. So trading commissions, the more you trade, the more commissions you make. So you engage in excessive trading, extensive trading for each of our clients to ensure she attains a minimum commission level set by the firm. So you are trading a lot for generating commissions for your benefit. So you are violating loyalty. Although the securities purchased and sold for the clients are appropriate. So suitability standard is not getting violated, only loyalty standard is getting violated. Why? Because you are unnecessarily trading in order to generate commissions for yourself. So Saunders Industrial Waste Management publicly indicates to analysts that it is comfortable with somewhat disappointing the EPS projections of $1.16 for the quarter. So publicly indicates public information. Roberts, an analyst at Coffee Investments, is confident that the management has understated the forecast earnings, and so the real announcement will cause upside surprise. So even though they are stating 1.16, he expects that it will be more. The whisper number estimated based on extensive research among the knowledgeable analysts is higher than 1.16. Roberts repeats the 1.16 figure in his research report to all coffee clients, but informally tells the large clients. So you are taking information given to you by the company, but what you are doing is you are unfairly giving the real information only to your larger clients and helping them to buy. So you are not fairly dealing with all the clients. You are treating the large clients unfairly